We're taking a look at the 5 worst performing Dow members in 2025. They include UnitedHealth, Salesforce, Nike, Procter and Gamble, and Honeywell. Markets and data editor Jared Blikre here now with a closer look at their performance in a series that we are calling Down Bad.
I get it. Thank you, Julie. And yes, even in a good year, somebody's still getting coal in their stockings. And we've got 8 Dow components in the red this year with a familiar list of reasons. We got healthcare bills, shopper mood, and even a little AI hype check. And today we are tackling the bottom 5. So let's pull up our Dow here. And this is going to be the year-to-date performance. I'm going to sort by best to worst, and now let's just start with UnitedHealth. This is a big one, and it is down 30% this year, 33% as you can see. Now, United got hit by a medical cost wake-up call. Management talked about costs running hot, and that turned into guidance drama and headlines about leadership change that investors did not love. And you can see the big post-Liberation Day drop there, which it hasn't recovered from, and this stock has now been down 3 straight years. But by late October, United said turnaround efforts were getting traction, raised its 2025 profit forecast. Nevertheless, costs remain elevated, and the big technical hurdles overhead are the $380 and the $440 price levels. This one isn't a meme stock meltdown. It is a core household name stock getting hit by the least fun surprise in America, the bill. And next up, we have Salesforce. This is down about 24%, which is basically paying the AI tax in reverse. Investors keep asking where the AI payoff is, and recently the message has felt more like wait and see than show me the money. Like United, this stock has been stuck sideways since those April lows, so even if it does pop on earnings here or there, the big question is whether AI turns into real paid demand or just nice features that get bundled and discounted. Salesforce brought the gift, and investors are now asking if anyone is actually unwrapping it. Next up, we have Procter and Gamble, which is down about 14%. Now, PG is the consumer mood ring, and lately the signal has been a little more nervous, with company commentary pointing to a choppier shopper backdrop. And you can see in this chart that the stock has just bled lower all year long, printing a 2.5-year low just a couple weeks ago. This is a kind of stock that doesn't need a recession to slip. It just needs people to trade down, wait for promos, or to buy one less thing per trip. Now, PG is usually a quiet stocking stuffer that you can count on, but this year it's more like socks that don't quite fit, somewhat useful, but not exciting. And then there is Nike, down about 11%, which is a good example of a turnaround stock that's taking longer than the market's patience. Inventory, discounts, and a channel reset have kept the story heavy, and the tape tells you the same thing. Nike has now been down 4 straight years, and earlier this year at the lows, it was down 70% from its 2021 all-time high. So investors want proof, not promises. But Nike is still Nike, and this stock just happened to spend 2025 running on a treadmill. Finally, there is Honeywell, down about 8-9%, which is a story of big change and bad timing. It's been floating a breakup plan that would unlock value through 3 separate companies. But this year, you also had a softer energy outlook that made the market say, okay, but when? Now, this stock has been stuck in a 5-year trading range and happens to be in the middle of it right now. So Honeywell is a stock in need of a catalyst in 2026. For 2025, Honeywell offered 3 gifts instead of 1, and investors asked for the receipt, thinking of a possible return. And you might be wondering about the prospects for a 2026 turnaround. So before I go, let's take a look at how 2024's dogs did this year. And I'll get that up here, and here we have them. Now, 2 of them, Intel and Dow Inc., were doing so badly that in November of 24, they were replaced with NVIDIA and Sherwin-Williams, respectively. Intel managed to turn a 60% drop into a near 90% gain return this year, but Dow doubled down, and its losses added up to 40%, and that's after last year's near 30% slide. And then after a 30% slide of its own in 2024, Boeing clawed back 15% as Nike's 30% fall was followed by an 11% drop. And finally, Amgen's 10% 2024 slip was met with a 22% gain so far this year. So all in all, it is a mixed bag with last year's laggards. Bottom line, the 2025 losers aren't broken companies. They're blue chips with specific 2025 problems. And the fun part for investors is what comes next. Which of these gets a New Year reset, and which ones are still wearing the same sweater in January?
Nike is one of the 5 worst performing stocks in the Dow Jones Industrial Average this year, and we're taking a closer look at the stock and the company as part of our Down Bad series. Joining me now, Anisha Sherman, Bernstein senior analyst. Anisha, it's great to see you. Now, I know that you have some optimism when it comes to Nike, and really, as we just talked about, the setup there is people sort of waiting on this turnaround to bear fruit. So I guess, first of all, I'd ask you where they are in that process, and then we can get into what needs to happen next year for the stock to come back.
Sure, Julie. So Nike got a new CEO about a year ago, and his first course of action was to clear a lot of old, stale product. And that resulted in numbers getting cut towards the beginning of this year, which drove a further correction beyond last year's already down 30%. In the last 6 months, though, the tone has sounded a lot more positive. They've cleared most of their old products. The new product that's out in the market is working. Actually, a lot of the new running product is selling through well. The new Vomeras are actually sold out, I think, ahead of the holidays. And they are regaining market share with retailers. So we are reaching the tail end of this big correction in performance and in inventory. And some of the new stuff is really resonating. So it does sound like they are turning a corner. That said, as your correspondent just said, the market doesn't have a lot of patience with turnaround stories right now and tends to be risk averse at the moment, especially on consumer discretionary names. So the stock is still not being given credit for some of the changes they're making, which I think should start to turn around into the new year.
Okay, and so what do investors really need to hear concretely from Nike to maybe change that perception as we get into next year? And by the way, the company's about to report earnings too, so we might get a little bit of clarity on that front.
Yes, so the biggest thing is top line growth. After several quarters of negative growth, Nike posted flat growth last quarter, which was much better than expectations. They have cautioned that this is not going to be a linear process. They've now guided again for slightly negative growth this quarter, but that is the biggest indicator. Once they can start getting the top line turned around, that also helps margins, it helps operating leverage, it helps the entire earnings growth algo inflect. And that's the biggest thing people are looking for evidence of, is they can start to grow again and gain share again and resonate with consumers again.
And you talk about in your latest note about Nike that lifestyle is sort of the missing piece, that in running they're doing better, in sort of performance they're doing better, but lifestyle. And maybe, I don't know if there are also some sort of cultural shifts that have gone away from the athleisure type look that Nike's presenting, or is it more product based that they need to come out with more appealing stuff?
It's a bit of both. So lifestyle was dominated by their Jordan franchise, which is part of what they were trying to clear over the last year. So when you're clearing old Jordans, it's really hard to generate brand heat on that same franchise at the same time. So they need to take a beat, sit out this year, and then rebuild their lifestyle portfolio led by Jordan, probably in a year or a year and a half from now. But in the meantime, they're losing share. And you alluded to cultural shifts. We've all seen that meme of people switching out Nike Tech for quarter zips. And that doesn't help them either. If people are switching out their look, going for a more preppier look, that doesn't resonate with the brand. That's another blow to the lifestyle portfolio over the next few months.
I guess we'll have to wait for them to come out with their own quarter zip, which brings me to another story I want to talk to you about. And this is one of the worst performing stocks in the S&P 500 this year. I'm talking about Lululemon, which has also really just struggled this year, hasn't been able to gain traction, just said that its CEO was stepping down. Is that what needed to happen for Lulu to turn around? What do you think its prospects are like for 2026?
I think Lulu is in a tough position right now. It is a market leader in the sportswear apparel market, which is a competitive and fragmented market. And there are lots of new brands popping up over the last couple of years with the help of social media and kind of ankle biters that are gaining traction and gaining consumer market share. And Lulu needs to stay relevant. And it's hard to do that when you are the market leader, the incumbent with the majority of market share. And that's what they need to deal with at the moment. The CEO change was a positive catalyst. The stock was up. The market was expecting that, perhaps not as soon as it came out. But I think it's the first in several steps they need to take to regain investor confidence and to grow again in the U.S., which they haven't done now for over a year.
I mean, they sell a quarter zip. Do you expect that to be a big winner for the holidays?
I do actually. I think that will be a nice boost to their sales this holiday. But it's a more widespread problem where their entire U.S. business has been shrinking for several quarters. So I don't know if one trend is going to do it.
Yeah, it's not like the bag that can be sort of the hero product necessarily for Lululemon. But that also brings me to another note that you came out with recently that obviously you guys had a lot of fun with. I had a lot of fun reading it. It is your top fitness products for going into next year that also sort of doubles as a potential gift list for people. That Lululemon quarter zip is on there. It's a pretty diverse list, actually. One of the other things that I know you're into that's on there is a sleep mask that sort of makes you look like a bug, I guess is called Manta, right? I guess that's why it's called Manta, I assume.
Yeah, there's a lot of interesting products out there, which are good stocking stuffers and also some bigger purchases, as well as just good lists. Fitness is the most popular New Year's resolution category. And so it's also an area that gets a lot of spending in early January as people are looking at their health and fitness goals. So the sleep mask was an interesting one. It doesn't press down on your eyes. It has lots of little bells and whistles with Bluetooth and with white noise that you can connect to. And so for people that travel a lot, especially on work, and are trying to get a better year of sleep in 26, that's one of the things we would recommend.
And speaking about shoes, also, you do have a Nike on the list, but one of the tops on the list is a new On running shoe that looks sort of like futuristic. And I guess that also speaks to, this has really been On's year in some ways. And so the inclusion on the list also doubles as kind of the recognition that they've been outperforming.
Yeah, I think this is my best idea in terms of a long-term compounder in global sportswear. It has low market share in every market, a premium product, no discounting or clearance issues, a strong management team, and exposure to several categories. So I really like the stock, but I also like the shoes. So these shoes are using their new light spray technology, which is effectively, if you think about a shoe being spun together by a robotic arm, it can happen in 3 minutes. You can look these videos up on YouTube, and they're now trying to scale this to be a scalable commercial running shoe. It looks very futuristic, no shoelaces, really cool look. So yeah, I think that will be a strong one that's coming out through in 2026 and should be scaling up. You should see it in your stores soon.
And I misspoke. On has not outperformed this year. The stock is down this year, so maybe that'll help it recover a bit going into next year. And then just one other product that you like here, a tote bag that I know you guys put on the list also. How do you guys go about even picking it? Do you sort of like crowdsource it amongst the team? How do you go about putting this together?
We crowdsource it. I will say one thing on. The company has outperformed. They've raised guidance 3 times this year, and their numbers are up, and they've been outperforming. The stock has suffered from a pullback from consumer discretionary and a rotation, which is also a reason why I like the stock into next year, because it's not driven by fundamentals. It's driven by more market sentiment. Gotcha. But yeah, the bag, I like it. It's a good weekender bag. It's a good crowdsourced item that we heard from several people they're using. Also good for business travel as well as for leisure weekends away.
I'm sure I hope you're doing lots of the latter as well as not too much of the former, Anisha, in the coming year. Thank you so much. Great to see you.
Thanks.
Procter and Gamble is one of the worst performing stocks in the Dow Jones Industrial Average this year, despite the index being up more than 13% overall in 2025. So we're taking a closer look at the company as part of our series Down Bad. Joining me now, Filippo Falorni, Citi Vice President of U.S. Beverages and HPC Lead Analyst. Good to see you, Filippo. So I guess let's first of all talk about what happened to P&G this year. And maybe, it's sort of capped off by the CFO talking about, personal product category sales being down. But what do you think sort of went wrong for the stock this year?
Yes, absolutely. Hi, Julie. Thanks for having me on. Look, I think what happened this year is that there's been an organic sales deceleration for Procter and Gamble. Just a couple of years ago, the company was growing 4 or 5% organic sales, which is a measure of volume and price mix. And then more recently, they've delivered more somewhere in the 1 to 2% range over the last couple of quarters. I think, look, there's a couple of components. I think the big one that drove of the deceleration is pricing. If you remember from 2021 to 2024, CPI was running very hot, and most of these companies were taking like mid-single digit pricing, high single digit pricing in certain categories. And that has slowed significantly to the point that now pricing is flat year over year, and in certain categories even down because companies are having to promote to stimulate demand. And then the second point, which you mentioned, this Procter and Gamble CFO called out at a recent conference, is that the consumers are cautious in their purchasing behaviors. And remember, P&G plays a little bit at a premium point in most of their categories. They are the more premium offering. And so they are seeing consumers being a little bit more cautious with their spending, a little bit of trade down, although not super material. And so all these things result in volumes being slightly negative, with pricing now also not growing much, and that results in flattish to slightly up sales growth.
Yeah, the company definitely doesn't want to see both pricing and volume not working for them. Okay, so what happens then for this company and the stock in 2026? Do you see any kind of inflection here for it?
I could see some improvement in 2026. I'm actually more optimistic on the space for a couple of reasons. I think what you've had this year is that you have really a normalization in sales growth trends. If you take a look versus the pre-COVID trends, most of the household product companies were growing sales, again, in this very low end of low single digits. I do think investors got used to like more mid-single digit growth on top line. But again, that was it was driven by very significant pricing that is not sustainable in this industry. So we kind of got the negative stock impact from the normalization of top line. And then as I look ahead of 2026, there were some discrete impacts that negatively impacted 2025 sales. The first one was the inventory destocking at retail. So at the beginning of the tariff this conversation, and when the first round of tariff were introduced in March and April, a lot of retailers focus on categories that were more impacted by tariffs. Right? Think about electronics, apparel. And so some of the more traditional household product categories were put on a second kind of priority list. So definitely the manufacturers sold less into retailers. You're going to cycle a lot of those impacts in early 2026. And then the other thing to me is like household product categories, those are daily use categories, right? Like we're talking about household cleaners, paper products, toothpaste. Those are categories that are very, very stable in terms of consumption levels. And so as you get to normalize this more cautious consumer environment, that's not going to be a year-over-year headwind for these companies. And so I actually do think there's going to be potential improvement in the top line trajectory. And the other thing is, look, in the consumer staple space, another big debate is the impact of GLP-1 drugs on food and beverage. And obviously, the household product companies don't have any risk more structurally in terms of demand. And so they could be also, from an investor standpoint, a return to these companies that are more stable within consumer staples.
Interesting. And you mentioned the effect of tariffs on ordering for P&G products. What about on its margins themselves and on the whole, pricing decision process?
Yeah, no, that's a good question. I mean, throughout the year, there's been a constant update from the company on their tariff impact on margins. We went from the initial guidance was 1.5 billion, 1 to 1.5 billion, and now we are about 700 million. So still very significant for the company in terms of increased cost. They did pass some surgical pricing, but as I mentioned before, pricing in aggregate has really decelerated because a lot of companies took significant pricing from 2021 to 2024, and they realized that the consumer could not take another leg up in pricing without compromising significantly volume. So there hasn't been a significant price offset to the tariffs. So that when you think about 26, that's another thing that you're going to annualize in terms of the impact. And remember also the initial tariff rates on countries like China was higher than what it ultimately came down to with negotiations. So a lot of these companies on a year-over-year basis are going to have a more favorable margin outlook into 26.
I'm curious too, Filippo. P&G has sort of rolled up a lot of different brands. So do you think they're going to be adding to the portfolio at all in 2026?
Yeah, look, M&A has been clearly heating up in my space, in consumer products. We've seen some very large-scale deal like Kimberly-Clark acquiring Kenvue, Keurig Dr. Pepper acquiring JDE Peet's. So we've clearly seen an increase in M&A activity. From the P&G standpoint, they've been very disciplined and rational with their acquisition strategy. And so I'm expecting them, if they decide to go with the M&A route, they will probably look more medium-sized deal rather than large transformational deals. They've done a couple in the past in their history. The last big one was Gillette. But they've also learned a lot from those large-scale deals. And the message from the company has been much more looking at kind of white spaces and portfolio gaps, but again, more in the medium to smaller size.
Filippo, thanks so much. Appreciate it.
Thanks for having me.
UnitedHealth Group. It is the worst performing stock in the Dow Jones Industrial Average this year. Shares are down more than 34% as the company deals with rising medical costs and regulatory scrutiny over its Medicare Advantage business. So we're taking a closer look at the company as part of our Down Bad series. Joining me now, Megan Fitzgerald, Columbia professor, Gregos Capital private equity investor, and Tenet Healthcare board member, former nurse. She's been in the medical investing industry for a long time. It's great to have you here, Meg.
You too. Nice to be on set.
So UnitedHealth is the biggest, and the biggest healthcare insurer, and it has been a turbulent time for healthcare insurers and for UnitedHealth in particular. So this year has not been a good one. What sort of has been the biggest challenge for UnitedHealth?
Yeah, I think, well, first of all, Fortune 5, one of the largest companies in the world, and I think it's important to note that they not only do insurance, they provide direct care. So they take full vertical risk of the patient. And I think medical costs, claims management, it just was a tougher operating environment, cuts in Medicare Advantage, and I think they somewhat lost their way on being able to manage some of these surprises when usually they're a bellwether to see where the costs are going. On a positive front, Q3 looked pretty positive, that they were getting underneath it, and they were guiding to say that they would be profitable and have a turnaround and have EPS growth this year. And so I think you're seeing the estimates come in where people are now seeing green shoots of that story. They've been here before. Remember, they started in 1974. They've been through numerous cycles of challenges in the market, and they've always been able to weather the storm.
I'm also curious about sort of public sentiment towards UnitedHealth. Of course, we are witnessing the trial of someone who killed a UnitedHealth executive that's been going on now. Public sentiment has not been great, but you're not usually, most people are not shopping around that much for their healthcare plan. So is that something that affects the business?
Yeah, listen, number one issue right now for Americans in healthcare is access and cost. Gallup has not seen it be this high in a long time. So with inflation, with all that's going on, healthcare costs are really troubling for patients. So some of that halo feeling definitely falls over to UnitedHealth because they're the health insurer. They're the one you have to buy your insurance through. And we're in the midst of the open market season right now where everyone's shopping, and they're not really seeing any relief on the subsidies. Congress can't get it together, although maybe this morning something's changed. So I think a lot of it is attributed to an insurer. That's not usually the group that you feel good about when you're out buying something.
Right.
And you have to not buy holiday gifts or, offset the purchase of a car or bills at home. It's a tough time for people, and I think they do share in some of that negative sentiment.
And I should say, UnitedHealth is the employer-sponsored plan here, so that's the one we've got by default. So Meg, what happens next year then? We've also seen not just UnitedHealth, but a lot of these companies paying out a higher percentage of their premiums to cover costs.
Yep.
So that's squeezing their margins. Does any of this get better in 2026?
I think so. I think we hit a nadir over the summer. I think right now United's 45% off all-time highs. CVS is up since the summer. United has been up since the summer. So I think we're starting to see light at the end of the tunnel, that they're managing. The medical loss ratio has come down for United. So they're really managing the book. And remember, they have multiple ways to win in terms of providing insurance, providing care. They have a pharmacy, they have a pharmaceutical benefit manager. So they have multiple ways to manage the patient. And for all intents and purposes, it looks like 2026 will be getting back to basics for United. Some have an 8% EPS growth. Some analysts are up over 20%. So I think what to watch on January, I think 27th, when they release earnings, is to see how do you reconcile someone that thinks it's 8% and others that think it's 20. So clearly, the market has a buy on United, and many feel you don't cut United out given their scale. I think we just run into a time where scale can be your friend, but sometimes scale can be complex for United, and I think they're working through it.
I want to talk more about the Affordable Care Act and those subsidies, and as they relate to UNH, but also just the broader industry. As you mentioned, there's some reports this morning that maybe Congress is figuring out, that we've seen some moderate Republicans join with Democrats to try to push through a vote on extending the subsidies.
Yeah.
What do we think? Is it going to happen, and how important is it that it happens?
Oh, I think something has to happen. So on the Republican side, you had an offer to maybe give $1,000 and work out some, type of alternative benefit option. And then on obviously the independent and Democrat side, and really the majority of Americans want the subsidies continued. And the raw math is if two people make $100,000, their benefit costs are around $7,000, and they were once $3,000 a few years ago. So in a time of inflation, that is really meaningful. The majority of the public wants the subsidies extended, which is why I think you saw 4 Republicans buck the trend this morning and say, we're joining the crusade. It's also a major voting issue. This is hitting people. It's personal, it's political, and it's affecting their lives. You could put off a car purchase, you cannot put off surgery. So I think they're going to have to come to some resolution.
And what are the implications for the industry of the extension of subsidies?
I think everyone wants these to extend. Nobody wants to have a patient go to the ER uninsured. We all pay for that. Everybody wants folks to have coverage. It's not so much about finding a physician, it's having coverage when you find a physician. And illness is growing. With a population getting older, people are having more illness and they're needing more care. And so having 30 million people not have coverage or have partial coverage, I think hurts all of us. That's not where I would focus. I would focus on waste and bureaucracy and administration. I wouldn't take a benefit away. It's very hard to take a benefit away.
And when you say you would focus on waste and bureaucracy, you're talking about how do we tackle this huge problem of medical costs being so high, which isn't good for us. It's not great for the insurers either, by the way, because they're the ones who are paying out that higher medical loss ratio. So are there real efforts anywhere? Are there models across the country in various systems to try to do some of this?
Yeah, I think if you look at our system, we have $1 trillion in waste. Look at something like prior auth. There's $300 billion in waste and prior auth. We all hate it.
So prior auth, just for people who haven't had to grapple with it, you have to have something done. You got to go to your insurer first and get that prior authorization.
Get the green light.
Why does that gum up the system? Why does that cost more?
Oh, it takes forever. You're in limbo, waiting it for happen. Your doctor has to file hours of paperwork. Doctors in the U.S. do twice the amount of paperwork as doctors in all of our peer countries. So if you work a 12-hour shift, add an hour for paperwork. And the prior auth is, did I green light Julie tomorrow for a procedure? And we go back and forth. Sometimes we delay the procedure because we didn't get the prior auth. Turns out 80% of the time, the prior auth is approved. That's just a staggering stat, that it's a waste. It's $300 billion of waste. So I think with AI and what we call a shift left, trying to green light the patients up front so you can remove some of the bureaucracy around billing and prior auth, I think would go a long way, and everybody wants that. So I think right now the administration should look at targeting waste and bureaucracy, which is what everyone wants, versus removing a care benefit that is really going to hurt a lot of people. And I think you're going to see that come up in the midterms. This is deeply personal, and it's highly ranking now among U.S. voters.
Yeah, for sure.
Yeah.
All right, Meg, good to see you. Thanks
Always
so
good
much
to see
for
you.
coming in. Salesforce is one of the worst performing stocks in the Dow Jones Industrial Average this year. Shares down more than 22% in 2025 as the company faced concerns about AI's threat to its software, pressure from activist investor Starboard Value, and as its AI monetization lags. So we're taking a closer look at the company as part of our Down Bad series. Joining me now, John DiFucci, Guggenheim Securities Senior Research Analyst and Senior Managing Director for Software. John, it's good to have you here because man, Salesforce has had a year. And it's been, Mark Benioff's really been trying to turn the ship around, but investors are definitely not convinced here. What to you is sort of the biggest thing that Salesforce needs to do to turn the narrative?
Hi, Julie, and it's great to be here. Most people think what they have to do is monetize AI. I don't necessarily think they're ever going to be able to do that. They have to embrace AI, and it's got to be part of what they do. Every traditional SaaS application vendor has to do that to make their products better, like they do every year. But they're probably not going to be able to monetize it because everyone's going to have it. So what I think they have to do is they have to do a better job of selling to the enterprise, and with good AI. Now they came out with Agentforce, as you know, a little more than a year ago, and it really hasn't done well because they had more marketing than they had product, and now they're trying to catch up on the product. But even if they do, I don't think they're going to be able to monetize it.
And what do you think broadly? I mean, this applies to Salesforce, as you say, but it applies to the whole software complex. I mean, are companies not going to turn to those sort of purpose-built solutions that these software providers are trying to give them? I mean, are they going to go straight to the LLMs, which are going to be giving them those solutions?
Yeah, there's this idea out there that everything comes full circle to everything being custom applications again, instead of packaged applications. I don't necessarily think that's in the cards, at least not anytime soon. AI is just not ready for that. And we'll see, maybe in 3 to 5 years that happens or it starts to happen. But I still think there's going to be a lot of companies that want a packaged application that builds upon best practices across the history of those companies, those packaged apps companies. So I still think there's room for these traditional application vendors. But if what you say even happens partially, it does have an effect on their relevance, right? They're very relevant today, or they have been up until recently. There's a lot of questions, but it will have an impact on the relevance going forward.
And John, the company made a big acquisition in the form of Informatica. What has that done for them? Because I know you pointed out in a recent note that there's just not the clarity that you would want around the financial contribution from Informatica.
Yeah, so what Informatica does, we don't think it does a whole lot for them, okay? It's not like Informatica did have a modern platform, but they also had a legacy business, an ETL business, which was the primary business of theirs, being able to integrate different kinds of data but it's mostly for structured data. If you really want, and they claimed Informatica was going to be this big AI play, you really have to integrate all kinds of data. Not that Informatica can't do it, it's just that is not what they primarily do.
Sorry, and John, just explain to me and to the viewers, what do you mean by structured data?
So structured data is the kind of data that most enterprise applications use today. It's data that can be used in a relational database. It's about 10% of the data out there. It is the data that for all applications used up until recently, because managing unstructured data like video files or pictures or things like that was just really difficult. The cost of doing that was greater than the value you got out of it. That's changed. Technology advances have changed that. Informatica has changed too, and they can manage unstructured data, but that's not primarily what they do. What I think Informatica does for Salesforce is they just buy some growth. I don't think it actually provides a ton of strategic value for them.
And so, okay, put all this together. What are the chances that Salesforce rebounds next year?
There's always a chance, and if you listen to them, they're very, very good at messaging or promotion. I don't think it's a great chance. I think there's just as much a chance as Salesforce's relevance continuing to moderate and their growth going from, low double digits, which is what it's been not too long ago, to high single digits, to mid single digits over time. And unfortunately, I think that's it. That's just as likely to happen as them rebounding.
So, John, I want to leave by talking about what you do think is going to do well next year, what your pick is for next year. And I got to say, this one surprised me, John. I'm talking about Oracle. You think Oracle is going to bring it back next year. As you know, there are a lot of doubts in the market about this one. What do you think people are getting wrong?
Listen, there's a lot of doubts in the market, and they have to do with debt investors, too. So and by the way, I've covered equities my career. So this is a little bit new to me, too. And I understand the customer concentration with OpenAI, and there's some questions around that and how they're going to pay Oracle over time. That's real. But the reason we're so positive on Oracle is because they just have a better mousetrap. Their cloud infrastructure is better than anybody else's out there. They provide a service with better performance at a lower cost, and they're still comfortably profitable. So if something happens along the way to some of their customers, which they don't anticipate, and I don't necessarily anticipate, I actually believe AI will progress and will be perhaps the most important advancement in technology in my lifetime. So I think that'll be fine. But even if it doesn't, even if a customer of theirs sort of has issues, there's enough demand out there, and Oracle's going to be the first choice for AI infrastructure, or any infrastructure it should be. We'll see.
We will see. John, we got to leave it there. Happy holidays. Hope to catch up with you about all this in the new year.
Thanks, Julie. Same to you.
Thank you. Honeywell, it's one of the worst performing stocks in the Dow Jones Industrial Average this year. Shares down more than 6% in 2025. So we're taking a closer look at the company as part of our Down Bad series. Joining me now is Amit Mehrotra, UBS Industrial Sector Head and Multi-Industry Analyst. Amit, so what happened to Honeywell this year? Obviously, there's a lot of structural changes at the company in terms of the one-time conglomerate becoming less conglomerated, I guess, so to speak. And most of the time when we see that happening, it's in order to unlock value. Why do we not see it play out exactly that way?
Well, good morning. Happy holidays, first and foremost. So
yeah,
on Honeywell, listen, I mean, this is a work in progress is the way I would characterize it. Keep in mind that the Honeywell stock price today does not reflect the spin-off of their advanced materials business, which is now Solstice. So that gives maybe $10 more to the stock price. But you're right. You're absolutely right. It's underperformed the broader market. Obviously, the broader market is being propelled by AI infrastructure spending. So I would say if you step back for a minute and look at the overall industrial complex, it's up about 16, 17% this year, while Honeywell has lagged. But that XLI has been really reflected of the haves and have-nots. So Honeywell, it does not have a lot of AI and data center exposure. And so when you put them in that bucket, they actually haven't underperformed the other names in industrials when the top performers are like the GE Vernovas, GE Aerospace, the Helmets of the world that are either exposed to these structural end markets that are growing at a very fast pace. But the bottom line is, as I look over the next 12 to 18 months, the opportunity is very much for Honeywell. They're going to affect their spinoff of the aerospace business in the middle of this year. They're repricing some OE contracts that have been out of the money over the last several years. They have an automation business that part of that is growing very, very strongly. So I think there's going to be an education in the market as this company goes from a conglomerate to simplifies its story, and hopefully that translates to outperformance. But they've got to execute, and they've got to deliver on that opportunity.
So it sounds like they're not necessarily chasing that AI build-out opportunity that the rest of the complex is, but you just think that the other businesses will be performing better independently than they were together.
Well, listen, there's plenty of examples of companies that simplify or spin off that ultimately translate to significant value creation. So, for example, when you look at the old United Technologies and what's come out of those businesses, when you look at Train Technologies coming out of Ingersoll Rand, when you look at GE Aerospace and Vernova coming out of GE, obviously these are different stories, and in any case, there's some stock-specific dynamics going on. But the bottom line is that when you emerge from a conglomerate into a standalone company with direct end market exposure, those management teams tend to be very focused and allocate capital more efficiently. And I think that would be the opportunity for Honeywell, but they've got to deliver. And so hopefully starting in the middle of 26 and beyond will be a new chapter for that company as they go down the simplification path.
Aerospace that part of the business has been doing better on a relative basis than most of the rest of the business. Do you expect that to continue going into next year? And we know that sort of defense spending, for example, that has been holding up.
Well, so Honeywell's aerospace business is a $17-18 billion revenue business. It's a huge business, and they've got good exposure to commercial aftermarket, defense and space, as you mentioned, and then also commercial OE. I would say part of that OE business has been under earning because some of these longer dated contracts have been, the inflation has outpaced their ability to recoup that inflation. Over the next 18 months, that starts to turn as some of these contracts get reset. And so the bottom line is that growth has not been the issue for Honeywell's aerospace business. Margin expansion has been the issue. One is their starting point is quite high. This is a 25-26% margin business. So by no means is it a bad margin business, but they just haven't expanded it to the rate that they have because of this OE versus aftermarket mix being exacerbated by some of these OE contracts that are just underwater. And so net, I would think that this is the company that's going to be giving their 2026 guidance this time next month. I think they'll be in a position to talk about high single-digit growth in aerospace, margin expansion in aerospace, which has not been part of the story, and then they can continue to build on that in 27 as they reset some of these contracts. So I actually think the aerospace story is turning from average to maybe not so good from a bottom line perspective to actually a pretty interesting, compelling margin opportunity starting in 26.
Gotcha. And sorry, Amit, OE, is there operational excellence business? Is that what?
Sorry. That's just my tech talk, so to speak. It's original equipment. So
original equipment. Thank you.
Yeah. I apologize. This is new aircraft that are being delivered as opposed to servicing existing aircraft that are already in the air.
Okay, gotcha. OEM I'm used to with cars, but that was a new one for me in this context.
Sure.
I'm also curious. Okay, so you have a buy, for the viewer, you have a buy rating on Honeywell. You've got a $268 price target, 12-month price target, which you've laid out the rationale for that. I do want to turn to maybe some of the other industrial stocks that you think could outperform next year. Johnson Controls is at the top of your list. I know you have a bunch that you think could do well, but Johnson Controls in particular, what is the narrative and the theme around Johnson Controls?
So, I would say Johnson Controls, is a very old and company with a lot of heritage, and they've gone through a lot of change over the last 20 years, certainly in the last decade when they merged with Tyco about 10 years ago. And I think there's just been a lot of money that's been left on the table as those mergers have taken effect, meaning I think there's a lot of cost opportunity. There's a lot of integration that can happen that just didn't happen over the last decade. And I think they have the right leader in place. In fact, the CEO is relatively new. He joined on March 12th of this year. He came from Danaher. Danaher obviously has a very good track record of business integration and operations and execution. And so the bottom line is that Johnson Controls is a mid to high single-digit growth company in our judgment at UBS. That's what we believe here. But there's also about $1 billion cost opportunity that we published and talked about that's 500 basis points of margin. So this is a $20 billion revenue company with about $1 billion of idiosyncratic cost opportunity based on our estimates, combined with a growth story. And so I think it really checks a lot of boxes because usually in industrials, you don't see a lot of cost stories being married with growth stories. And with Johnson Controls, you have both the cost story and the growth story. Stock's up 45% this year after being up 45% last year. So by no means is this a cheap stock today. But the point that we're trying to make at UBS is that if you have some vision about what this company can earn in 27, 28, 29, JCI is a very cheap stock on those earnings numbers because of that outsized cost opportunity. So we would highly recommend our clients, and we do highly recommend our clients put new money to work in a name like Johnson Controls because of those two dynamics on growth and costs.
And while I got you, I got to ask you about some of the other names you've alluded to, because they've also done quite well this year. You know, AG Vernova, Vertiv, I know is one of your picks, 3M. I mean, industrials have, by and large, there are some exceptions, but by and large, they've done pretty well this year, in part because of that AI build out. How much more run room do they have on the back of that theme in particular?
I think we're just getting started. The bottom line is that, you know, when the industrial economy turns from recession to growth, it doesn't happen for a month or two. It happens for about 3 years. We're still in an industrial recession, believe it or not. And what I would say is that, you know, when I think about the different pockets of exposure, so data center infrastructure build out, you know, between 25 and 27, so in the next 2 years, the spending of hyperscalers for infrastructure or data centers is going to grow by 60%, 30% just in 2026. So if anybody's calling the top on this, you know, last time I checked, bubbles don't burst when everybody's waiting around for them to burst. The bottom line is that is going to be highly accommodative for that theme that's been supportive of the economy. What I'm most interested in, what I think is most differentiated in what we're saying, is that the non-AI CapEx cycle, which has been an industrial recession, is starting to wake up from its long hibernation. We are seeing companies, whether it's Parker Hannifin, Dover, you know, all these old world industrial companies start to actually report organic growth and some acceleration. And I think that's a sign that the non-AI CapEx cycle that has been absolutely not accommodative is starting to be accommodative. And then when you layer on the fact that these companies have pricing power, some cost opportunity, you get to very, and let's not forget, interest rates are going down. We can all debate about, you know, how much they're going down and the magnitude of the decline, but we cannot debate about the direction of travel over the next 6 months. And so when you have AI CapEx accommodative, non-AI CapEx starting to be a little bit more accommodative, and then Fed cuts, those three are very important stools of the overall economy in the market, and they're both quite accommodative. So hopefully if you have me on a year from now, we'll be looking back and we'll still be showing an industrial economy in the XLI and the industrial equities that are up double digits after being up double digits this year. And then we could debate 27, but I think the next 12 months looks pretty good.
I love how fired up you are about it. I know in industrials, you don't always have these kinds of moments. So you got to grab it while you can, I suppose. Thank you so much. Appreciate it.
All right. Happy holidays. Thank you.
You too. Thanks.